Hi everybody, this is Ellman, the blue-collar investor, with today's covered call writing question of the day. Today's question comes from William, who actually asked two questions about buying back the option. William asks, do you buy back the option at the same strike you originally sold? Here's the example. I bought VRX at $77.55 and sold the June $77.50 call option for $245. The stock then skyrocketed to $91.80. My question is, should I buy back the $77.50 option at the current ask of $14.80 to prevent the stock from being assigned? Thanks for your help. Well, William, many of our members ask questions regarding buying back the option to prevent assignment of the option and the sale of the stock. Let's first take a look at your trade. You bought 100 shares of VRX at $77.55. You sold the June 77 near the money call for $245. Your initial return on your option was $245 minus 5 cents, which is the amount the strike price was in the money, divided by $77.50, using the 5 cents to buy down our cost basis from $77.55 to $77.50. So we have an initial return of 3.1% for the 1 month. Not bad so far. Now, the current price of the stock, as you said, skyrocketed to $91.80. Which means that our 3.1% is looking darn good at this point in time. The current option value, as you stated in your question, moved up to $14.80, and that's the ask column. Remember, we buy at the ask, we sell at the bid, the lower. Okay, so now let's take a look at your first question. Do we buy back the option at the same strike we originally sold it for? And the answer to that question is a resounding yes. In order to cancel our original option obligation, we must buy back the same strike in the same month and the same number of contracts. So after selling to open, we then buy to close. That's the terminology used when you go onto your website to execute these trades. You initially sell to open, STO, and then if we're going to close the short options position, we buy to close, BTC. Now, once the option is bought back, we simply own the shares with absolutely no obligation. So we're free to sell another option, we're free to do nothing at all, we're free to sell the stock. Okay, that takes care of question number two. Question number one, let's take a look at your second question. And your second question is, do we buy back the option to prevent assignment if the price moves way up? Well, early assignment, meaning prior to expiration Friday, is very rare. It's possible, and usually when it does occur, it occurs when there's a dividend distribution prior to the expiration. But assuming that there is no dividend, it's very unlikely that your shares will be sold prior to expiration Friday. But tax issues aside, who cares? If this stock is sold, that means we've maxed out our trade, and now we have additional cash in our account to set up a second income stream in the same month. So a lot of people are concerned about their shares being sold, but to me, the stock is just a vehicle that allows us to generate a monthly cash flow. The stock is sold, we simply move on to another vehicle. Now, there are times when I do consider buying back the option when the stock price gaps up. And that has to do with the time value of the premium approaching zero. Because as the strike gets deeper and deeper in the money, which means the price of the stock goes higher and higher above the strike price, the time value of that premium will approach zero, and the stock will start to trade at what's called parity or all intrinsic value. So Let's take a look at the actual premium that you discussed in your question and see how that plays out. Now, as you stated in your question, the total premium is $14.80. So let's figure out how much of that is intrinsic value and how much of that is time value. The intrinsic value is the difference between the current market value and the strike price. In this case, $91.80 minus $77.50, or $14.30. So of that $14.80 total premium, $14.30 is intrinsic value. That leaves 50 cents as time value. So that's actually what it will cost us to close our position, $50 of time value. Now that represents a 0.6% debit, less than 1%. So if we can generate more than a 0.6% return by closing our entire position, and that should be relatively easy if there's a few weeks left until expiration Friday, then it may pay for us to buy back that option at $14.80. Just a matter of running the calculations. So there you have it, William. Answer to both your questions. First of all, yes, we do buy back the option at the exact strike price that we originally sold it for. And there are times when it does pay to buy back that option even at a high price, but not for purposes of avoiding assignment and the sale of our stock, but rather for instituting a second income stream in the same month with the same cash. So, turns out an excellent question has a lot of ramifications, and I appreciate your asking that question, William. And I appreciate all of you out there for watching this video. I hope you found it useful. As always, this is Ellman, the blue collar investor. Take care, everybody.